That sounds great, Marty. Great panels today, and I've really enjoyed it. And hello to everyone out in San Francisco. I'd like to thank you for being here for our discussion on venture capital. Last month, we had a discussion in New York about venture capital. I cited a few themes from PitchBook's valuation report that came out in October. And just to give you some quick highlights, it said seed deals are still getting done at the same clip and on terms as in recent years. Early stage continues to be a flashpoint of value creation, but the speed of that value creation is slowing down as the bar for re-ups and new rounds of investment increases. Bridge financings are becoming a little more popular among those companies. Deal metrics for growth stage companies have fallen by 60% from highs just a couple of years ago. Later stage deals can delay their capital raising, and now as a result of that, the time it's taking between rounds is close to 2 years. The IPO window is quiet. 27 public exits in 2023, raising $21.9 billion. That's up from the second quarter, but down significantly from previous years. So flash forward now to December, and middle of December, PitchBook came out with its outlook for 2024 for venture capital. Some of the headlines there were positive economic signals through 2023 will spur a comeback in IPOs in 2024. US VC capital raising is expected to increase, making it stronger than 2023, but comparable with 2020 figures. US active unicorn count and aggregate post-valuations will continue to decline a little bit. Flatter declining interest rates in 2024 will lead to an increase in US venture capital activity, as well as with non-traditional VC investor participation. So accelerators are expected to continue to play an important role in the momentum for 2024, although the average fund size of a venture capital fund will decline a little bit in 2024. And then today, there's a big headline in PitchBook saying, venture capital looks for sunnier skies amid the clouds. So there you go. We go from October to December, and there seems to be a lot more optimism in December, but they're sort of checking that today. Fortunately, we have 3 fund managers, Jayon Wang, who's there in person. We have Zhang, who's also there in person. And we have Eric Ball, who's with general partner with Impact Venture Capital. And they will take us all through this and explain why their marks have remained constant all through 2023. For those of you who attended yesterday's program on private debt, I want to remind you these are equity folks, so their glass is half full. In fact, they see opportunity in the portion of the glass that's filled with air. So my name is Mark Heil. I'll be moderating this panel. I am the managing director of Pickwick Capital Partners, a FINRA registered advisor to the middle market companies and alternative asset fund managers. We provide specialized strategic and transactional services, providing a full range of investment banking and fund placement advisory services. For the next hour or so, we're going to have a conversation around venture capital. I'd like to invite our audience to participate. Keep in mind that we have a limited amount of time, so be respectful of our speakers' time and get to the point with your comment or questions, and we'll be very grateful to answer that. If we need more context, we'll be glad to ask for it. A quick disclaimer here. Information presented is presented for educational purposes only and is not intended as or may not be relied upon as tax, legal, or investment advice. To the extent myself or other panelists express an opinion as part of this discussion, those are their personal opinions and not necessarily the opinions of their firms. So with that, let's meet our distinguished panel here. If you would just introduce yourself, talk about your background, and then talk about your fund as well. What number fund is it? When was it raised? The sectors you like, the size of the checks you like to write, all those sorts of things. And Jayon, if you do me the favor, please kick us off here.
Yeah, sounds good. Can you guys hear me on the Zoom?
Sure
Okay,
can. Coming through loud
great.
and clear.
My name is Jayon Wang. I'm an investor with Norwood Point Ventures. We're actively investing out of a first fund called 1540 Ventures. We're raising a second fund for 1540 Ventures. Our specialty is looking at medical devices, digital health, healthcare IT, and really technologies that touch the patient. We typically invest early stage, so we're looking at seed rounds, Series A's. My background, I'm a mechanical engineer, have founded 2 medical device companies. Formerly, I was an investor at General Inception, where I was leading our medical device, imaging, and digital health team. Have an MBA from Harvard Business School and really focused on investing at that early stage technology, translating research or scientific developments through to commercialization.
Great. Lou?
Yeah, happy to. Hi, glad to be here and really looking forward to the panel discussion. My name is Liu. I'm the founder, managing partner of IvyFON. We're a Silicon Valley-based VC firm focused on earlier stage healthcare enterprise AI in the industry automation investment. So I started firm in 2015. So in the past 8 years, we've been invested across the United States, have over 80 portfolio company, mainly in US, a little bit in Canada. Now we're actually investing out from our Fund 3, which we got very lucky on the timing. We did final close on Fund 3 in the January 2022. If you remember, that was right before the market crash. So we have $120 million dry powder, be able to deploy capital with a really favorable term with a founder and also continue quickly build up the track record within Fund 3. My personal our typical check size is $1 to $3 million to start in the seed pre-seed stage. So we take a major position with a founder, 10 to 15%, sometimes 20% ownership, also lead position and be on the board. Meanwhile, we continue pro rata in the Series A round, B round, and later, then we could build up long-term relationship and be a long-term supporter to the startup companies. And my personal background started with my hometown, which is in the Mongolian. I always like to mention that because typically I'm the first ever Mongolian for lots of people I talk to. So I came here in 2010 for graduate school. So I'm a material scientist from Stanford and later built a medical device company, which I eventually sold it to Boston Scientific. After I sold my company, which I own 70% when I did merger acquisition deal. So I got good financial returns, start to explore angel investing. And in 2015, that's the start of the IvyFON.
That's great. Where's your fund headquartered?
Palo Alto, not too far.
Perfect. Not too far at all. Eric, you want to introduce yourself and tell us a little bit about your fund?
I do. Thanks. And I had hoped to plan to join locally. I'm only 30 miles away in Woodside, but I have some viral pneumonia and decided none of you needed to mess with that. So I've got decongestants and I'm ready to rumble virtually. I started my career as an academic, studying finance and economics. And then I spent over 30 years as a finance executive in several large corporates. The last 11, I was the treasurer at Oracle. I issued $52 billion in bonds to pay for 103 acquisitions on my tenure, and I managed the corporate venture portfolio there. I spent a year after that as chief financial officer at an AI unicorn C3, long before it was a unicorn. And then in 2016, I co-founded Impact VC with Dixon Dahl and Jack Crawford to create a corporate-friendly independent VC investing in early stage applied AI business models. Typical check size, 500,000 to $1 million initial size, and feeding our winners after that. We raised 2 funds to date. Fund 1, 2017 to 19, $25 million fund. Fund 2, from 2019 to 2021, another $25 million fund. And we're currently raising our Fund 3 with the same investment thesis. And I'm proud to say that I have at least one company where I'm a co-investor with Lou's firm, and happy to collaborate on that.
That's fantastic. Are you going to give us any details on that one company?
Oh, it's a capital markets company. It's fintech, capital markets tech, and it's a company called Cap Connect Plus that's created a true auction platform for corporate issuance of debt. And to get away from kind of the antiquated book building model that the investment banks manage, which works out well for some players, but not as well for the issuers. and trying to get to a true auction clearing model for debt issuance. And very excited about the prospects for that startup.
I'm sure there's a lot of people in the audience who'll have some questions for you about that company. You and Luke can certainly answer those and talk to them about it. Eric, I know you put together a couple slides. Would you run us through them? It's just going to be a couple minutes and sort of the high ground. I sort of gave some points a few minutes ago, but he's really going to take us a little bit deeper here.
Sure. Are you seeing my my cover slide?
We're seeing about 4 slides all at once here,
Oh,
including notes. And so maybe you want to just, I think you hit
all
the
right, let me
wrong one
figure
down
out
at the
how to
bottom.
make those go away.
There you go. Now you're back. If you go down to your bottom right-hand side where you see the like, there you go. Click on that. You'll get just, now it takes us
Okay.
back to what we're seeing before.
Well,
Well, maybe just
okay.
go back to what you had before and
I think
we'll just
so.
work from there. Yep,
How's that?
that's better.
Scroll that up a little bit. Not sure why that's happening. Yeah, I just wanted to take a handful of slides with some metrics that we're seeing, and really, looking at the early information from PitchBook as of end of Q4. So where are we in a macro set in the venture ecosystem right now? You gave some statistics about how overall investment is down. I would just say that within that broader sort of downward trend, we're seeing an upward trend in certain subsectors, including the use of AI across verticals and geographies, funding coming globally, and with the engagement of large corporates. I wanted to put venture into context with other asset classes, and forgive me for showing some of my notes here. Not sure how to undo that, but just very quickly, if we look at what and how venture is compared to other places you could have put your capital in since just before COVID, other asset classes have been volatile. The U.S. stock market has ranged from down a third to up by half. It's currently up by half. The public stock market outside the U.S. is flat after being down by a third and up by a quarter. Fixed income returns are really not high. They're higher than they were, but not after inflation. And real estate is relatively flat and volatile since pre-COVID. So, I would argue that several of the other asset classes are giving us the volatility that you would associate with venture, but without as much upside as we might associate with venture. I happen to think that venture should be a part of any portfolio, not just because it's the highest returning asset class looked at on an individual basis, over long horizons at least, but because it's imperfectly correlated with these other asset classes, so it'll go up and down at different times. Just to dig in a little bit to some of the numbers that Mark expressed earlier, if you look at the venture capital deployed into startups, it went up dramatically over the decade prior to 2021, and it peaked in 2021. Then since then, it dropped by a third in 2022, and as of last week, when 2023 ended, it was less than half of what it had been just 2 years prior. So startups have been starving for capital. They're getting less than half the capital they were getting just 2 years ago. You pointed out, Mark, that that's extending the period of time between rounds for startups, and some of them are falling through the cracks. It also means that the valuations are lower, and I think that makes them attractive. If you look at the venture funds, they stopped deploying capital after 2021, but they kept raising capital through 2022. And in fact, they continue to raise record capital even after they stopped investing it. So there's a lot of dry powder. But in 2023, both GPs and LPs cut their investment dramatically. And so in 2023, we saw a 6-year low in the number of US VC funds raised. That was down over 60%. So it is a little bit of a desert, both in terms of funds raising capital and startups receiving capital. Having said that, we're primarily a seed stage investor. We note that the statistics around the attractiveness of venture as a whole, and in particular early stage venture, hasn't changed. It's got the highest long run return among asset classes. and it is more variable. But if you add it to a portfolio, the imperfect correlation helps compensate for the variability, and it does not necessarily raise the variability of one's portfolio as a whole. We note we're very corporate focused, and we note that even with the downturn in capital raised and capital deployed, corporate influence remains dominant. 10 years ago, fewer than 1 in 10 venture-backed deals had a corporate investor. Last year, we still had corporates involved in about 2/3 of the deals by dollars, although they've been erring a little bit more toward the larger deals, arguably quality over quantity. But corporates are still a big driver in the venture ecosystem. And then the very last data I want to throw at y'all for context is the history of good vintage years in venture. Obviously, it matters a lot which particular fund manager an LP invests in, but you do see some vintage years where the average fund investor does better than other vintage years where how the average fund investor does. And we went back and looked at some of the data after other sort of macro challenges. And if you look at, going back to 1987, the tech.boom.com bust of 2001, 9/11/01, and the financial crisis of 2008. In each of those instances, the vintage year and the year or two following those macro disruptions tended to be good vintage years. And if you just look solely at the 2008 crisis, and you think about some of the good firms that got their seed rounds done in the year after 2008, that includes Stripe, Square, Uber, Lyft, Airbnb, WhatsApp, Groupon, Glassdoor. It was a great vintage year for early stage venture after the financial recession. And so I think that what I take out of this data is simply that right now valuations are depressed. Investors can get attractive terms, and it's a great example of deploying to venture now is a chance to buy low. And that's just a little bit of context, but what we're seeing in the market.
Hey, Eric, one of the great debates inside of family offices is, go direct or go through a fund. So could you make the case for why it makes sense to go through a fund like yours or lose or?
I think it's just a simple matter of access and accessibility. A lot of family offices, they get pitched by a lot of startups, so they certainly have no shortage of investment opportunities. But I think that a lot of them find it somewhat random which opportunities they connect to and which ones they don't. With a fund, I think you get people who aren't doing 10 different things. Like someone running a family offices, all they're doing is looking for attractive startup opportunities in a particular sector or space or investment thesis. And one of the things we tell our LPs is invest in our fund as a source of deal flow, and you get the chance to co-invest with us on any particular companies that you find attractive. So I think it's largely a matter of deal flow access, and also getting the pre-vetting and the diligence that comes with getting these from a fund. So you're not just seeing the opportunities, but you're seeing, which ones we're excited about and a description of why we're excited by it. So that's why I tell folks, yes, you pay a fee, you pay carry, but you really get something in return for that.
And Lou, when you were out raising capital and you just closed the fund at the end of 2022, and you've got a lot of dry capital sitting on the side, was this a point of conversation with a lot of your investors, and how did you respond to it, and what was their thoughts on it?
Yeah, so we did a final close in January 2022. So we've been deploying capital from Fund 3 for a while. I agree with Eric. I think the first is really access. I know some of the VC talk about we meet with so many funds every single day, but in reality, 90% of early stage startup doesn't even worth your time to talk to them because they won't be successful. Then among the rest of the 10%, probably less than 1% really worth to putting money in. And for example, for our Fund 3 right now, we did an intention to do so, but when we analyze the background of the top founder, among our 20 company investing so far, 2/3 of the founder are repeating successful founder. They're the founder did it before, and they want to do it again. They got financial freedom. So when they launch a new company, they're not only looking for money, They're looking for valuable money to bring in potential customer, strategic value, partnership, and also help them in the future exit. That's the reason this type of founder, they typically put themselves as a stealth mode. It's hard to access. Really echo what Eric said. Yes, there's tons of company in the market, but you don't want to put money into lots of this company or trying to desperate raising money from all different type of investors. You want to be on the top one deal. And regarding the due diligence, I think it's really based on the sector. I think consumer side probably is easy to do due diligence. It's more about understanding the psychology, social psychology. But for the sector we're focusing on, healthcare, enterprise, AI, and industry automation, requires understanding of technology first to pick whether it's a good technology to invest. Because industry not only need good technology, they also need better, faster, cheaper technology. How to evaluate that? Another thing is sometimes people without technical background got fascinated by the best tech or maybe some big idea. I keep getting questions. People ask me, I'm a material scientist. They're like, oh, why didn't you invest in nuclear fusion? Why didn't you invest in quantum computing? I'm like, because I study all this field. I know they're so far away from commercialization. We're not National Science Foundation. We couldn't invest in company, wait for 20 years to do commercialization, want them to make money in the next 1 or 2 years. So that's another important part about evaluating tech from the right perspective. The last piece is really portfolio management. That's also kind of the evolution of the fund. My fund one, we didn't take too much of the kind of board seats. We start to taking more board seats. On one side is having more influence over the company. Another thing is protect ourselves. Company got a different type of offer. Today, one of my founders just called me and we got a merger acquisition offer. As a shareholder, we want to make sure not only we aware of the opportunity, we influence on them for making the right decision. And when the situation happen like that, we also make sure the terms are also favor to not only founder, but also to us. So I think all these three value we provided to, on top of just investing in good company, also make LP feel more comfortable working with us. We have some family office, very big ones, super successful family backed, but they just feel through access of the fund manager, they could just a cherry picking from the top company we already invest. That's another thing. I think not only us offering, lots of other VC offering as well. With our LP, after we put in capital, we also share direct allocation to our LP. So LP could invest along us. They could benefit from the due diligence we did already. And since we're gonna continue to do the portfolio management, so they don't need to worry about they have to spend extra effort out putting the team to do portfolio management, just to tag along with us. So that's become a very popular mode I found from lots of family office. They allocate 50%, 50% or 70% from investment, 30% direct. Turns out be a win-win situation.
Yeah, that sounds terrific. And I want to just, John Cataldi has a question here, so I want to field that.
I appreciate that. Miss Lu Zhang gave some great information about the amount that she invests and in essence, the ownership. Could Jayon and Eric do the same? I have as far as ranges of investment, the stage by which that is invested, and what is the in essence the terms look like from percentage of ownership with the portfolio you'd be taking a stake in.
Yeah, I'm happy to go first on that. Our fund actually invests through 3 distinct models. The first is, I would say, more common to seed investing, where we'd like to lead investments with anything from $1 to $3 million. And we're typically looking for early enough stage technologies where we're receiving something between 15 and 25% of that business on a preferred stock share and a board seat, so we can really influence forward decision making. Second model that we'd like to do is actually syndicating with strategic investors. I think this showed up in Eric's slide. Many of the deals that we're pursuing actually have a strategic CVC, a corporate venture capital firm, that's coming in, anchoring either the business development of that company or potentially in their pipeline for future M&A. We do like to syndicate with those corporate venture capital firms. And for those, we're typically looking at a slightly lower ownership percentage, something between 5 and maybe 15%, but taking terms of that strategic lead investor. And then the last model that we run, which we think of is pretty difficult to operate, but with that higher risk comes a much higher return, are what we call kind of a co-founding investments. These are with really nascent either research or scientific developments. We're coming and actually structuring that company. We'll bring the first maybe $1 million, $2 million to the development effort in exchange for oftentimes north of 50% common stock and preferred combination. So we actually are really driving the ship in that case. And we're operating both as an investor, but also maybe as an executive in that business. And I'll just couple, I think, on the previous question of why organize through a venture fund as opposed to investing directly. I think a lot of what we do has to do with our strategic partner and the vertical that we're in. I mean, the deals that we're looking at typically are not first-time founders or founders we haven't worked with. When times got tougher, we really pulled back to invest only in founders that we've either known for a 5-10 year period or founders that we'd either worked with or backed before. And they exist in a continuum where their new ventures aren't, back of the napkin ideas that came up a month ago. These are research projects and efforts that have been going on for 5-10 years. So that really allows us to sort and mitigate our risk. We're not in the business of avoiding risk, especially since the 3 panelists are all early stage here. We actually want to take risks. Our work is in taking calculated risks and managing through that so that we can have an outsized return from that larger risk that we're taking. So there.
Eric, you want to follow up?
Yeah, I'd love to. Our approach has some overlap with both Lou's and Javon's approach. I would say that our typical entry point is $500,000 to $1 million at a seed stage company, and much of the time those companies will be valued fairly low. As the first institutional investor, a high percentage of our companies we invest in are still below 10 million in valuation. So a $500,000 to $1 million investment is usually at least 5 and often 10% of the company to start. And then what we do is we set milestones and we feed our winners. So to the extent the company is meeting its milestones, we'll continue to invest at least pro rata in the next round or two. And once it gets to a point where it's hard for us to keep up because the check sizes are getting too big, then we use our pro rata rights on behalf of our LPs and other co-investors to get them access to rounds which may be oversubscribed. So 500,000 to $1 million, usually 5-10% or more of the company to start with. And then, like Jayon, we make very specific targeted instances where we invest more. There are 2 companies in our portfolio where we chose to be founders, where we actually filed the articles of incorporation ourselves to help the companies get started. And we took a larger equity stake early on in those.
Hey, Eric, can I just for a second? Can you just, people are having trouble hearing you, and I want them to be able to hear your wisdom there.
Okay. Yeah, I'm not sure. I thought I turned up my volume. So let me try again to do that.
The extreme close up.
Yeah, exactly.
We could hear you better. I think it's maybe you got to
without
distance from the computer. The closer you are to it, the better off you are.
Right. Is that any better?
It is.
Yeah.
Awesome. Anyway, just finishing that thought. With those companies that we take the larger stake in, it's commensurate with usually a larger time commitment. And then we have a subset of companies where we have 10 to 20% stake rather than 5 to 10% stake. But we try to maintain a meaningful stake by being often the first institutional investor in a seed round.
And can I have one more follow-up question to that? Is that
sure?
All right? And I stand on both sides of the table, being both a venture capitalist and also once you have the companies up and operational, the portfolio end of that as well to continue their growth and longevity. A lot of people don't understand the amount of value that you bring well above just the capital to the table. Can each of the panelists discuss briefly the type of insight and additional I guess knowledge base that they bring to their deals, and from an investor aspect, what has been your rate of return in your previous or historical funds?
Yeah, I'm happy to get started. I love to talk about it because I was an entrepreneur myself. And when I start Fusion, I have lots of founder friends joke about, you went to the dark side. It sounds like a shark now. I'm like, I could be a dolphin, still predator, but intelligent, full of compassion. So we really think from entrepreneurs' mindset and perspective, how we could better support them. And meanwhile, attract the best high quality founder work with us. So we build out different ecosystems, supporting them to grow. One called the CXO Network, which I launched in 2018 together with my partner, Shane. He's the former CTO at HP, and he also is a serial entrepreneur himself. And for lots of the high quality founder, they don't need micromanagement work on product. They don't need strategy, etc. advice. They just need you to open the door for them to get market validation, which is contract. So since 2018 till now we have 44 members in our CXO network. It's Fusion CXO network. All of them are CTO from Fortune 500 companies. Every quarter, we have webinar. So we share insights, they share panel. We feature 3 founders talk about their case study. Every single webinar generating some partnership and also contract value. So when we came to founder, our pitch is very simple. I'm like, you could raise 10 million from Andreessen. Either you go with very high valuation, or you have to think about consequences of your dilution, or you only raise 5 from us. And then we bring another $2 to $3 million contract from one of the major customers we have, and also some non-diluted capital. Which one is better for you? So that become a really powerful network we've been maintaining to attract the best founder, especially serial entrepreneur founder working with us. Another network we built up called the Expert Network. This is a group of the industry leader, including some serial entrepreneur who are already done with entrepreneurship, want to support others. So they could also serve as advisor, independent board member with our portfolio company. Especially when our founder reach out to us saying that, okay, you're on the board, we're looking for independent board candidates before Series B round. We have a list of candidates with their board bio, directly reach out to. They want to set out the advisory board. We have this high quality, highly relevant talent they could directly access to. Other things, it just, I think lots of other VC does as well, is just providing different coaching. We just make it more materialized. I created documents called How to Startup 101 when I launched Fusion Fund, because that's the thing I wish I knew when I was founder, including how to effectively manage your board. After the OpenAI drama, we have lots of founders say, Lou, so glad that you have this material for us. How to manage and lead your board, we have a training material. How to run an effective fundraising process, training material. How to check your IP and file patent, whatever, like working, we have all the material. How to read a term sheet, so founder could directly access for the access and read it through. Sounds like a simple, silly question, but it's very practical and important for lots of founders to know. They could go to Stanford Open Class, learn about bigger vision and how to change the world. But practically, when you work on the company, this thing matters, and also CEO has to spend time, hundreds of hours on it when the initial get started. Another thing we do is also mutual benefit for both founder, us, and also LP. We did quarterly industry research report. All of the information I just mentioned is all available on our website. So if you're interested, feel free to go down our website, and we have community. We have industry research report we run every quarter. So we collect information, which technology is ready for commercialization, and a list of information, and which industry are ready to have allocated budget to potentially be the customer. And combined together, we have the industry research report. JP Morgan Healthcare Conference this week, so we published one report focused on digital biology. It's available on the market, on our website as well. The internal version is at 40, 50 pages long with more intels, and also list of the company, list of the partner, list of the investors you're focusing on, available to our founder, to us, to our LP. Public version is only 10 pages. It's kind of overview, but we share on the website. Just want to also promote and help the industry in general. So there's more thing we do. We actually have a founder hub on our website. List out all these different resources we provided to the founder, and founder could directly reach out to us to access. Even for founder not in our portfolio, we offer quarterly office hour. So my team dedicate time, 2 hours per week, just put it on the website. You could just schedule 10 minutes meeting with them. We call it Ask Us Anything. If you have any questions about the startup, we could answer to really build up the long-term reputation and the community within the innovation ecosystem. So long story short, it's just so much work you need to put in for the value add-on, because that's the reason good founder want to take your money. Especially lots of founder we work with. We have a founder, himself is a billionaire. And why he want to raise capital anyway? And the reason he wants to raise capital is because he wants to find the right partner to help him hit the milestone for commercialization, bigger exit, and finding the right partner on the board to support him to grow the company. So we want to make sure we have all the resources we could provide it to support the best founder.
Fantastic.
It may come as a surprise, but it's not unique to OpenAI to have founder disputes and board issues. You know, every medical device company or liquid biopsy company, doesn't matter what stage that, suffers these same things. And I think as early stage investors, a big part of our job is helping those founding teams avoid these somewhat obvious and very repeatable speed bumps that tend to kill companies. Killing those, you know, the 9 out of 10 seed stage startups that don't make it to Series B in commercialization, they're not all losing because of, you know, Thermo Fisher came into their market with $200 million more than they did. Oftentimes it's actually personnel issues, governance issues, and those are the places, structuring issues. Those are the places where I think the scar tissue and repeatability of our business models and our experiences can actually add value. And you might be hearing this from both of us because both of us were founders before we became investors. But I think that especially when times have gone harder, that DNA actually translates much better to secure teams that can last through up times, down times, and actually make it to market. End of the day, that's when, in some sense, our job never finishes. We've gotten to the point that we're really intended to, and you know, we're not late stage investors for a reason. That's when our peers that are really more focused on pro formas, financials, and market access can really do their job. So hopefully that helps.
I want to actually just shift it here a little bit if I could. I'd like to move towards, and one of the reasons I'm doing this is Marty's giving me the hand that we got about 5 more minutes. So, so we're flying here. So I want to talk a little bit about the exit markets and the next rounds and valuations, because I think they're all interrelated. And I guess my question to you is, what are you doing to prepare your companies now for their next round? And when do you, obviously every company's on a different timetable, and I know you have a whole resource Lou of things available, but you're coaching and talking to them. Eric, I'm going to ask you to start on this. What are you doing to help get them ready for the next round or the next event?
Well, the main thing we're doing is coaching them that it may take longer than they think. We have a high percentage of companies that, you know, have a cash constraint, and so first they say they're going to do a Series A, and then they say, well, that looks hard. We're going to do a bridge to the Series A. And I explained that even doing a bridge to a Series A is not the slam dunk today that it was 2 years ago. So the first thing they need to do is cut their burn rate, conserve their cash, and assume that the next fundraise is going to take longer and be more painful than they're used to. And so this market rewards disciplined companies with conservative cash flow. And there is still money to be had. There is still financing to be done, but you have to stand out, because with valuations depressed across all stages, as an investor, I'm looking at the opportunities and saying it's not just what looks like a good opportunity, but what is the best among all the good opportunities. And I have that same sort of triage with my existing companies where I'm looking at follow-on investment. I can get follow-on terms at very attractive rates. So it's not just who do I believe in, but who do I believe in most. And I try to communicate to the entrepreneurs that every investor is kind of looking at it that way. So you need to show discipline. You need to conserve your cash, and you need to build in enough time, to really allow people to see why you stand out and why you should be one of the folks who deserves a follow-on, valuation and investment. And I'd say that I see a lot of companies simply reopen. They might have made a year's worth of progress, but they're reopening their rounds at a year ago's valuation, and sort of, a flat valuation is the new up in this environment. And just coaching people through this, that it's not simply enough to say, I've got this great sales pipeline, so, money should flow in, but really explain to them the realities of the market and why it's different than it might have been a year or two ago.
Jayon, you want to follow up on that?
Yeah, I think the nuances in how you ask the question, I think our answers for our own portfolios differ immensely from how we see the broader early stage marketplace. Of course, we want to support all of our portfolio companies and our founders that have made progress in the last several years to raise their next round. And I see it exactly as Eric. A flat round is an accretive round. But observing the broader early stage ecosystem, I think probably comes as no surprise. 2023, I don't think we actually saw as many company failures, dissolutions, or quote unquote company deaths as anyone would have expected, which means that the parking lot of companies that are subsisting on lower burn rates, grant funding, or in some cases, bridge, convertible notes, or safes, has grown. I don't know if you can put an exact percentage to it, but I'd imagine it's upwards of 20, 30, 40%. Those companies need to raise funding this year. And really, even as a former founder, my take to our portfolio, as well as companies not in our portfolio, I think this is the time where you really pick your best value add board members for the journey ahead. And that's going to be 3 or 5 years in our industry, because most of the companies we're investing in are pre-commercial, pre-revenue, right? So
Hey,
if they're
Jay,
going
can
to
I
take,
get you just for a second? Is the sound on in your computer?
I think,
you
well,
could-
there's a
If
microphone
you
in
can
front of me.
mute it. Yeah, I know. I'm thinking I'm picking up both, and it's creating a little.
I don't think there's any reverb, but if somebody has theirs on, turn off their microphone.
Okay,
Mhm.
we'll go from there. Just keep going. You were doing terrific.
In
I'm
any
sorry to
case,
interrupt.
with depressed valuations, I think what's going to end up happening is this is where value-add investors actually contribute their largest value to these companies over the next 3 to 5 year build cycle. And our advice is really pick who you want to work with. I mean, if it's going to be a flat valuation and you're going to end up selling more of your company at the next round, really pick very carefully who you want to work with for that next period of time.
Yeah, I totally agree with the other two panelists mentioned about be very practical on fundraising. Another thing for us is we're very practical. So since the moment we're putting capital in, we really focus on helping growing the company's revenue. So when market like this, founder have the flexibility to choose what they want to raise. Because if they don't like the term, they could generate blood themselves. They could continue going. We have this company called Otter.ai. Some of you may use it before. So they raised Series B in 2021. They haven't raised since then. And now their revenue is over $62 million, have less than 30 employees. So per employee generating $2 million ARR. No, they've been profitable since last year. I have another company. They're aiming for IPO next year. Not next year, this 2024 already, this year. Of course, there's lots of uncertainty about IPO market, but they are generating $2 billion revenue. That's now the valuation. That's my first investment in Fund 1, coming with a valuation of $4 million. So it will be a major return for the fund. So I feel like one company have the revenue number, not only they have more flexibility, also they have a better expectation on the timeline. And meanwhile, when they decide to raise a round, we have a couple companies raise a round last year. Last year was really tough. They were all oversubscribed because there's capital on the market. It's just investors being more picky, being more practical. They don't really invest in concept, invest in the reality, cash on cash return. So they concentrate capital to the top performing company. Another thing I want to quickly tackle, because Mark also asked, is about exit. I think that might be similar across 3 panelists. I think we're all in a similar style, very practical, not only just thinking about IPO. IPO is a fascinating story, right? Everyone wanted to saying that I'm aiming for IPO. But in reality, for us, we model 20-30% of a company per fund would consider IPO over $1 billion exit. For the rest of the company, we'll consider merger acquisition. And merger acquisition could be good. And we start to generating liquidity start from year 3, year 4, year 5, and the return principal back to LP. Before year 5, then they could just be more patient, waiting for the big one to coming out. And another good news is market become very active right now for merger acquisition. We have the CXO network, so we have the first-hand information. I literally have the CTO tell me, oh, the board approved over $1 billion budget for us to potential buy company or give contract. And meanwhile, we are all in healthcare as one of the sector focus. Last year, there are 17 deals within life science, merger acquisition, deal size bigger than $1 billion. Never happened before. So when we see merger acquisition could over a couple $1 billion size, which means become a more flexible option for us to consider exit and liquidity. And meanwhile, as early stage VC, we have more better timeline to really consider when to return principal and when to create the fund multiple.
Well, fantastic. I thank you all for your great insights. I'm going to ask you just to give a quick wrap up, and then we will turn it over to Tyson and his panel. Um,
All right.
not quite yet, Tyson.
Oh, all right. Never mind.
Eric, you want to lead us off? Hey, we're
Yeah.
just wrapping up here. Final thoughts.
No, just final thoughts. My message is sort of an evangelist for the asset class is that investment is down, valuations are down. This is the right time to deploy to venture capital. Some of the U.S. institutions feel like they're over allocated based on their large commitments they made in 2021 and 2022 before everything stopped. And some of them also feel like a lot of GPs haven't marked down their positions sufficiently, and so they're nervous about their existing positions. But that's all concerns about past capital. My point is, whether you were over allocated before or you're getting allocated now, this is an opportunity to come in at an attractive valuation point for direct investment, for fund investment. The best vintage years have tended to follow years of challenge. And so I think this is the perfect time to be deploying capital. Our own strategy is early stage applied AI, but really leaning into those corporate connections. Our chief source of value add to our portfolio companies is introducing them to corporate venture arms that they might not otherwise meet. And so that's kind of where we're, viewing our secret sauce as. But you see different models. It's a good asset class to be in. Don't pick one manager, pick a couple of managers, diversify your risk across managers and vintage years. But you can't do well unless you participate. So I think it's a great asset class for family offices.
Jayon, you want to take just a minute and give your final thoughts?
Yeah, very quickly. I think our firm's strategic positioning is that we want to work with corporate venture capital going forward. I think in the last economic cycle, corporate venture capital changed some of their activities, terms, likeliness to do deals. I think that especially with the forward-looking economic horizon, that's going to change. And our firm, in some sense, was created and is raising a second fund in order to take part in that, take advantage of that. So almost all of our deals will have involvement with our corporate strategic partners. It's part of our, ability to chase alpha, distinguish ourselves. And if anyone wants to learn more, just reach out after the panel. I'll be happy to tell you more.
Great. And Lou?
Yeah, so first echo what Eric mentioned, this year is going to be a really good vintage year for early stage. That not only we say so, when we talk with LP say that as well. Another good thing about this year and the last year the market was hot and the valuation probably slightly lower compared with this year, but the market was not very clear. But this year we'll have more clear market landscape regarding a super powerful tool, which is AI, coming to all different industry drivers for productivity improvement. So that's really the one major thing. Really great time for early stage vintage year, early stage investment. That's also a reason you saw lots of the larger one, like a larger fund, the $1 billion fund, rushing into the stage we're focusing on right now. So we do plan to launch our fund 4 later this year. So happy to start building up conversation with potential investor early on, and we're always open to develop new long-term relationship. Second is really we'll just get started. I know last year everyone was fascinated by ChatGPT AI. We've been investing in AI since 2017 for AI in healthcare, and also generative AI. The first generative AI search engine, U.com, was investing by us in 2021. So we're very early and understand the ecosystem very well. We just get started. Last year, there are lots of discussion about transformer model. This year, we're going to see less discussion on that model because new model is coming out. So we just get started in a great technology trend at the beginning point. I'm super excited. Every single day, I think my team is super excited. We do industry discussion, just feel like so many opportunity came out. It's not only for tech industry. It's not only for Silicon Valley. We focus on logistics, manufacturing, insurance, financial, healthcare. That's all the industry with huge amount of high quality data could be powered by integration of the digital platform and AI. So that's another thing I really want to share.
Thank you so much. Give them a big hand. I'd ask our panelists to please put your contact information into the chat so everybody who's online can reach out to you. There's been several people asking, so if you could do that. Marty, thank you very much. You have a great afternoon. Great panel, great discussion.